Let's pick up on that with Stephen Nash from FIIG Securities, standing by for you in Sydney. Stephen, good morning, as always, and welcome into the show. What do you make of this? Some saying, look, deficits, you don't have to be a debt fetishist, you can perhaps just go a little bit lower down the ledger on that front. Don't tinker with Medicare, don't tinker with levies.
Look, I think we're in a transition phase between stimulation by the public sector and handing over to the private sector in terms of the expansion. I think some people have justified concerns about actually placing a fiscal drag on the economy right now. I think, as we were emphasising last week, this flood has implications for the fiscal situation, and the government seems to be responding to that quite quickly. And I think, yeah, there's going to be the levy, and I think the idea of increasing the deficit at this stage is probably not good for the bond market. I think the government has made promises regarding the return to surplus. I think they should at the moment try to keep those.
Except for, I mean, obviously our debt position's far better than many places in the world. We couldn't just add, you know, a few billion to it. Would that make such a difference for the bond market?
Look, I think within reason, a few billion either side possibly will be okay. I think the idea is to broadly hit that target, and I think the government will do that. I think there's a lot of spending effectiveness reviews that need to be done. There's a lot of trimming that could be done without wouldn't have much effect on employment. I think the government really has to look at that pretty carefully.
You know, one of our earlier guests this morning, Craig James, was saying, look, the contingency fund is there. The government's obsessed with ring-fencing that for the national broadband network. Is it time to have a bigger debate, Stephen, about the use of the contingency fund in these situations? Isn't it putting horse before the cart to build infrastructure ahead of broader nation building?
Look, I think given the flood, there's a big opportunity for the government to say, look, you know, things have changed, we have to reduce some spending. And I think also look at things like the contingency fund and possibly use that in an appropriate circumstance. And I think, you know, to some degree this is an appropriate circumstance, yeah.
Do you see, we're looking at the figures of, say, $5 extra a week to raise that Medicare levy, to impose that the flood levy on Australians. Do you think that would be a drag on consumer spending at all, given that obviously some non-mining related sectors of the economy are already struggling?
Look, I think that it's all about perceptions and whether this affects consumer sentiment to the extent that consumers say, well, here we go again, more taxes. Is this the start of something bigger? Obviously, at the moment it isn't, but the problem will be what perceptions are taken in terms of the next move. I think sentiment's already quite fragile. We've seen quite weak readings already, so this will damage perceptions. And also we've had that CPI release out on Tuesday, suggesting that these global deflationary pressures are a little bit higher than people expected, and there are some suggestions that the RBA might look at an easing to offset mortgage cost increases. I think that's a bit preemptive, but that's a possibility. All
right, just one of those deflationary aspects, of course, going back to the United States, you did get a sense from the Fed that still things are sticky on the longer term inflationary expectations. They're saying that the underlying inflation trend is only one way, and that's down, not up. What do you make of then the political response overnight, the State of the Union address? Is that enough to get inflationary expectations sort of ramped up?
Look, I think State of the Union is the start of something. It's not the end. It's the start in the sense that there's a start to a more responsible approach to the fiscal position. I think that's really important for the Treasury market. The Treasury market's been very concerned about a government that has spending ambitions that are just too large, and I think this is very positive for the Treasury market.
Some would suggest that he walked a very fine line, very carefully. He didn't go really out there to make any big announcements or anything. Nothing new came of it, some people said to us this morning. Do you think it was enough?
I think that's a common complaint about the speech, that there wasn't enough substance. There's a big change in rhetoric towards the centre, but there's not much action. However, as I said, I don't think it's the end. I think it's the start of a move towards the centre for Obama, and I think this idea of reducing spending is really positive for Treasuries. Really, the US have to do something about spending. The rating agencies have put time limits on the US to get their house in order, and I think they're starting to do that now. So I think it's all up. It's positive, but we haven't seen real effects of it right now. We had some rally on the night, but that's been offset by recent data. Yeah.
Okay, Stephen, looking like we're getting the wrap up. I'm going to have to leave it there for now. Many thanks. Have a great day. Many thanks.
Okay, thanks.